The simplest ways to make money in cryptocurrency, with its volatile nature, has opened up numerous avenues for making money beyond just buying and holding. Whether you're a seasoned trader or a newcomer to the crypto space, there are several straightforward ways to capitalize on this emerging market. Here are some of the simplest methods. Number 5. Buy and hold. HODL. Investing in promising cryptocurrencies for the long term is a strategy often referred to as HODLing, a term originating from a misspelled post on a Bitcoin forum in 2013 that became synonymous with holding onto cryptocurrencies regardless of short-term price fluctuations. This approach is based on the belief that certain cryptocurrencies have the potential to increase in value over time due to their underlying technology, adoption, and utility. To implement this strategy successfully, investors must exercise patience and conduct thorough research to identify projects with strong fundamentals and long-term potential. Fundamental analysis involves evaluating various aspects of a cryptocurrency project, such as its technology, development team, community support, use case, and market demand. Bitcoin, as the first and most well-known cryptocurrency, is often considered a staple in long-term investment portfolios. Its limited supply, decentralized nature, and widespread adoption as a store of value have contributed to its resilience and long-term viability. Ethereum, with its smart contract functionality and vibrant ecosystem of decentralized applications, dApps, is another popular choice for long-term investment due to its potential to revolutionize industries beyond finance. In addition to Bitcoin and Ethereum, there are other established coins with proven track records that investors may consider for long-term holding. These coins often have a history of stability, liquidity, and community support, making them less susceptible to market volatility compared to newer or lesser-known projects. Number 4. Trading cryptocurrencies involves participating in the dynamic and often volatile market by buying and selling digital assets with the aim of profiting from price movements. While trading can be lucrative, it also carries inherent risks, making it essential for traders to possess a combination of knowledge, skills, and risk management strategies to navigate the market successfully. One of the fundamental requirements for successful trading is understanding market trends and dynamics. Traders must stay informed about factors influencing cryptocurrency prices, such as macroeconomic trends, regulatory developments, technological advancements, and market sentiment. By analyzing these factors, traders can identify potential opportunities and anticipate market movements. Technical analysis is another crucial aspect of trading cryptocurrencies. This involves studying price charts, patterns, and indicators to identify trends, support and resistance levels, and potential entry and exit points. Technical analysis tools such as moving averages, relative strength index, RSI, and Fibonacci retracement levels can help traders make informed decisions based on historical price data. Risk management is paramount for traders to protect their capital and minimize losses. This involves setting clear entry and exit points, defining position sizes based on risk tolerance, and using stop-loss orders to limit potential downside. Additionally, diversifying trading strategies and assets can help spread risk and mitigate losses during adverse market conditions. Traders can adopt various trading styles based on their preferences, time horizon, and risk tolerance. Day trading involves executing multiple trades within a single day to capitalize on short-term price fluctuations. Swing trading focuses on capturing medium-term trends by holding positions for several days or weeks. Position trading, on the other hand, involves taking longer-term positions based on fundamental analysis and macroeconomic trends. Regardless of the trading style adopted, it's essential for traders to remain disciplined, patient, and emotionally detached from their trades. Emotions such as fear, greed, and FOMO, fear of missing out, can cloud judgment and lead to impulsive decisions. Developing a trading plan with clear rules and sticking to it can help traders maintain consistency and avoid costly mistakes. Number 3. Staking. Staking has emerged as a popular method for cryptocurrency holders to earn passive income while contributing to the security and functionality of blockchain networks. It is primarily associated with proof-of-stake (POS) cryptocurrencies, which rely on validators rather than miners to validate transactions and create new blocks. In a POS system, validators are selected to forge new blocks based on the amount of cryptocurrency they hold and are willing to stake as collateral. To participate in staking, cryptocurrency holders must lock up a certain amount of their coins in a digital wallet, effectively making them unavailable for trading or transfer during the staking period. This locked-up amount serves as collateral and incentivizes validators to act honestly and follow the rules of the network. In return for staking their coins, validators have the opportunity to earn rewards in the form of additional coins or transaction fees. The process of staking typically involves running a staking node, which requires a stable internet connection and sufficient computing resources to participate in the network's consensus mechanism. Validators are responsible for validating transactions, proposing new blocks, and securing the network against potential attacks. In some POS networks, validators may also have the opportunity to vote on governance proposals and protocol upgrades, giving them a stake in the decision-making process. Staking rewards vary depending on factors such as the network's staking protocol, the total amount of coins stacked, and the validator's uptime and performance. Generally, validators with higher stakes and consistent participation in the network are rewarded with a larger share of the staking rewards. However, validators may also face penalties for downtime, malicious behavior, or violations of network rules, incentivizing them to act honestly and maintain the integrity of the network. Staking provides several benefits for cryptocurrency holders, including the opportunity to earn passive income, support the security and decentralization of blockchain networks, and participate in network governance. Additionally, staking offers an alternative to traditional mining, which requires expensive hardware and consumes large amounts of energy. By staking their coins, holders can actively contribute to the sustainability and efficiency of blockchain technology while earning rewards in the process. Number 2. Yield farming. Yield farming has gained significant traction in the decentralized finance DeFi space as a way for cryptocurrency holders to maximize their returns by providing liquidity to decentralized exchanges, DEX, and other DeFi protocols. At its core, yield farming involves depositing funds into liquidity pools, which are smart contract-based pools of funds used to facilitate trading on DEX. By providing liquidity to these pools, participants earn rewards in the form of interest, trading fees, or new tokens issued by the protocol. These rewards are distributed proportionally to the amount of liquidity provided and the duration of participation in the pool. Yield farming opportunities can vary widely, with some protocols offering fixed interest rates while others employ dynamic algorithms to adjust rewards based on supply and demand. One of the primary attractions of yield farming is the potential for high returns compared to traditional investment avenues. With interest rates on savings accounts and traditional investments at historically low levels, yield farming offers an alternative way for investors to generate passive income and grow their cryptocurrency holdings. Additionally, the ability to earn rewards in the form of new tokens can provide exposure to emerging projects and potentially lucrative investment opportunities. Number 1. Airdrops and forks. Airdrops and forks are two methods commonly used in the cryptocurrency space to distribute free tokens to holders of particular cryptocurrencies, albeit with different mechanisms and purposes. Airdrops typically involve distributing free tokens to holders of a specific cryptocurrency, often as part of a marketing strategy to promote a new project, attract users, or reward existing community members. These tokens are usually distributed directly into the wallets of eligible holders based on certain criteria, such as the amount of the cryptocurrency held or participation in specific activities or communities. For projects launching a new token, airdrops can help bootstrap initial adoption and distribution by leveraging the existing user base of another cryptocurrency. By distributing tokens to a wider audience, projects can increase awareness, incentivize participation, and build a community around their platform or ecosystem. Airdrops can also serve as a means of rewarding loyal users and early supporters, fostering engagement and loyalty within the community. Forks, on the other hand, occur when a blockchain protocol undergoes a significant update or change that results in the creation of a new chain diverging from the original one. This can happen for various reasons, such as disagreements among developers, changes in consensus rules, or the need to address scalability or security concerns. There are two main types of forks: soft forks and hard forks. Soft forks are backward-compatible upgrades that do not result in a split of the blockchain, while hard forks are non-backward-compatible changes that create a new chain separate from the original one. In the case of a hard fork, holders of the original cryptocurrency typically receive an equal amount of the new coin on the new chain, effectively duplicating their holdings. From the perspective of cryptocurrency holders, both airdrops and forks can present opportunities to accumulate assets at no cost. Airdrops provide recipients with free tokens, which they can choose to hold, sell, or trade on cryptocurrency exchanges. Forks, on the other hand, can result in the creation of new coins that holders of the original cryptocurrency receive automatically, allowing them to diversify their holdings without additional investment. Would you like it? Hit the like button and subscribe to our channels for more interesting and informative videos.